Yes, we live in the information age, the age where you can literally figure out the answer to any question you can possibly imagine. The problem is, sometimes it's hard to figure out if those answers are actually correct. Big piece of that is it's hard to figure out who to trust. Well, today we have a guest that I have a very high degree of trust in, and he has access to all the data in the whole world of commercial real estate, and you'll know why once you hear his intro. So today we're going to talk about the state of real estate, particularly commercial real estate after COVID, in the wake of COVID. So, number one, multifamily. This has been something that's on everyone's mind, people's homes, where people live. That really drives a big piece of the economy, especially the renter base, which is very, very significant. How is the multifamily sector doing? And which classes of multifamily have been beaten up the most post-COVID, and which are best positioned to mitigate this risk? Also, development of self-storage. This has been a topic of conversation for quite some time. What is the current state of new development starts when it comes to self-storage, and what does that tell us about the asset class over the next 2 to 3 years? Also, there has been a very significant move out of the major cities in the United States for people that have the ability to do so. So what does this mean for New York? What does this mean for San Francisco? Are these cities going to recover, or is this a, quote, new normal where people are looking to the burbs to get a little bit more space in the wake of the shelter-in-place orders? And how is this all going to play out in the office sector? We've got so many people working from home now. Many firms are saying working from home is now an amenity that we're going to offer a lot of our employees. What does that mean for big box office? All of that coming up very quickly. Now, if you haven't yet created an account with ASIM Capital, make sure to do so. The reason that we do this show is to help investors be educated in the world of passive investing. But I can tell you something from personal experience. It's a lot more fun making money than it is listening to podcasts. We listen to the podcasts so we can get those high rates of return on a risk-adjusted basis. So if you haven't yet created an account, make sure to do so. We have a deal coming up that we've been working on for quite some time that I'm very excited about. And I'm very confident it's going to be one of those deals that a big percentage of the listener base is going to be very interested in. So go over to asimcapital.com. That's ASYM capital.com. If you're an accredited investor, create an account, and you will be the first to receive the deal once we let it out over the next couple of weeks. All right, thanks again. How's it going, everyone? Our guest for today is Andrew Rybczynski, who is a managing consultant at CoStar Advisory Services, where he makes recommendations on investments in commercial real estate. Andrew frequently speaks and writes on the multifamily property type in particular. He has a background in data and spatial analytics, and he uses these skills to provide data-driven research for both clients and the wider market. Andrew has been a guest on the program before, episode 131. We'll link to that in the show notes page. Today, we're going to talk about how this data has changed over the last few months, given that we've had concerns surrounding COVID and shelter-in-place orders. So, Andrew, thanks so much for coming back.
Yeah, thanks for having me, Hunter.
So, obviously, a lot's changed since our last conversation, and I'm very interested to hear some of your thoughts on the totality of what's going on in the economy as a whole, but also, in particular, how some of these different asset classes have really been impacted by COVID and the related shelter-in-place orders, and in particular, the different markets, the different classes and such, and how they've all kind of interacted with what's going on in the economy. So let's start out with multifamily, something that I think you're definitely tracking very closely. From a big picture, what does the post-COVID world look like in the multifamily sector?
Well, I would say generally we're still pretty bullish on multifamily in the medium to long term, but of course the short term is a little bit different. We came into this pandemic with a pretty big supply pipeline. So we had over 650,000 units underway in 2019. And while a lot of that did get delivered, we had about 110,000 units delivered in the first quarter of this year. You still have a pretty big supply overhang. And when you couple that with an unemployment rate that skyrocketed and generally weaker economic forecasts, we expect weaker demand going forward. And that leads to rising vacancy rates, which then tends to lead to lower rent growth. So very big picture, that's the view. However, as I said, in the medium term, we're a little more sanguine. We think that there's still pretty good demographic argument for multifamily. Certainly, single family is going to become difficult to purchase in a situation where household finances are more stressed. There's also for the next 5 years, the prime renter cohort of 20 to 34-year-olds still continues to see some growth. Granted, not the growth that we saw, let's say, 5 and 10 years ago, but it does still continue to see some growth. And I would also point to the fact that average marriage age continues to increase while the birth rate continues to decline. So both of those hold back family formation, which typically keeps young people renting longer.
Would you say that propensity to get married, to have a family, et cetera, it seems like in the short term, we've seen obviously a lot of weddings have been postponed because of shelter-in-place orders or just concerns around the virus itself. Do you also see that working out into the long term as well, where when you have recessions, people tend to be less quick to have children, at least intentionally? What are your thoughts on that?
That is something that's powering my thinking. The birth rate has been in a 10-year decline since the last recession. So the Pew Research Center has put out a paper on this. Typically, you see birth rates decline in a recession, and if you go back historically, that's what happens. But as the economy improves, you tend to see those birth rates recover. That did not happen this time around per CDC data. Perhaps if the recovery had continued for a couple more years, we would have seen a tick back up. But it did not happen through this recovery. And as I mentioned, recessions do tend to decrease it. So there is a counter argument to be made that births have been, age at first birth has been increasing. So we have within the cohort of 20 to 44-year-olds, the largest cohort is 25 to 29-year-olds. So as they move into that 30 to 34-year-old range, there's an argument to be made that they could push the birth rate up because of those later birth years. But having looked at the numbers, it's only a marginal increase over what is already existing. And running a pretty basic trend forecast out, I anticipate at least the number of children to continue to decrease, or number of children being born continue to decrease, which is indicative of a lower birth rate.
Understood. And it's kind of working two sides of the same coin, in the sense that you could certainly see a situation where someone had the financial means to purchase a house. Maybe they'll fill that house up with babies. And since they don't, they aren't. And it could be that both things are working together. It's difficult sometimes to see the causal relationship. But regardless, that's the trend. You mentioned the vacancy rates. What are the actual data points on those vacancy rates? How significant is that from a proportionality standpoint?
Well, just one note on that home ownership and kids aspect. It has been referred to me as a chicken and egg problem where, does home ownership lead kids or does kids lead home ownership? I believe that both are led by finances.
Yeah.
What we've seen is that richer families have taken a larger and larger share proportionally of families with children. So poor families and especially middle-class families are having less children than they used to on a proportional basis. But yeah, the vacancy aspect, we have seen vacancy move up. Again, it's just a matter of a large supply overhang coupled with weakened demand. Our numbers indicate not great, but let's say middle of the road demand for 20Q2. But it was a situation where developers and our initial forecasts expected pretty strong demand. And so you get a vacancy rise. I would say particularly we've seen vacancy go up in unstabilized buildings, which is not surprising. Certainly there's news out there about tenants being more likely to renew right now in order to avoid moving house.
Mm-hmm.
So buildings in lease up, it seems like have taken a particular beating on vacancy.
Yeah, that is exactly the question I was going to ask. So we did see this pretty significant from a historical standpoint increase in development, particularly in Class A. And then you could certainly see a situation where in order to fill those vacant units, you have to have people move in. There's big challenges with that. Number one, sometimes it's been very difficult to get people to come in just to see a property. Also, the foot traffic has been drastically reduced. Also, people are less willing to move. So how are kind of the different asset classes within real estate, the different product types, as in Class A, B, and C, being hit, given that reality when you kind of contemplate that so much of the development has been in Class A?
Yeah. So CoStar does track daily rent series, and we can split them out by Class A, B, and C. Class A did get hit the hardest and the quickest, and it took the longest to recover. So I generally point to the supply issues when asked about that. Class B did also take a pretty hard hit, although it recovered quicker, and it's leading the way on rent growth now. Class C, as far as our rent data goes, took a pretty minor hit, and it continues to kind of putter along at a lower rent growth. So the daily rents kind of create an issue here because Class C tends to see consistent low rent growth throughout the year, while B and A are much more cyclical. So in the latter half of the year, they see much lower rent growth than in the first half of the year. So while Class C tends to outperform on a yearly basis, it underperforms in the first part of the year. So I think it's pretty telling that vastly overperformed in the first part of the year this year. Now, one thing we've been warning about is that the tenants who occupy Class C buildings are far more likely to have experienced job losses through this downturn. Retail and leisure and hospitality were two of the hardest hit sectors. Those also tend to be two of the lowest paying sectors, and they are therefore some of the most likely to be Class C renters. Additionally, younger people who also tend to make less money saw the greatest rises in unemployment. So again, you kind of got a cross section there that tends to hit Class C more. The one saving grace has, of course, been the CARES Act and this enhanced unemployment insurance. So I'm sure you've seen the stories about people making more by staying home from work than they did by going in. And in many respects, that's what the bill was designed to do. It was designed to keep people at home and slow the spread of this virus. But the result is that those people have been able to pay their rent, and we've been getting pretty good numbers back on rent payment across property types, but throughout apartment and throughout this recession. But that unemployment insurance runs out at the end of July, and that's what we really warn people about with the Class C apartments, is that those renters may find themselves without that additional income going into August.
Yeah, and that's very much aligned with the data that I've seen as well. I braced for something very, very significant in terms of challenges with collections. We didn't know if we were going to experience 90% collections or 60% collections. And that's not an exaggeration. I had many conversations with experienced operators, and we just had no idea. Now, of course, the CARES Act did change that number significantly. And especially in Class C, where $1,200, for example, or $600 a month, that goes very far proportionally to the other expenses. The challenge, though, which is what you're alluding to, is that tenant base is more likely to be a victim of unemployment given the situation. They have less savings in their accounts, so that if there is a challenge in the future, or if that government money runs out, which it will at some point, which is a not very useful claim, given that we need to know the timing in order to take advantage of it to some extent. That's kind of the big risk at the point. So let's talk about kind of the markets. I mean, I think a lot of our listeners aren't really super allocated to the super prime markets, but I have seen just anecdotally such a move out of these major prime markets like New York and San Francisco. I'm starting to wonder what this looks like in 5 and 10 and 15 years, where what's the justification of spending so much money on a really small apartment in New York if you can't go out with your friends to nice restaurants? I mean, that's the reason people like to live in those big cities. What are your thoughts there?
Well, let me ask a clarification question. When you say New York, do you mean the island Manhattan or the surrounding areas as well?
I do mean like the most densely populated prime areas within Manhattan, New York City in particular. San Francisco is another example where we've seen an exodus to the suburbs. How do you see that play out, where people are moving, at least anecdotally, away from apartments and into single-family houses in a lot of these major cities?
Yeah. So, outside of the anecdotes, I'll quote a bit of data. We have, again, that daily rent series broken out by suburban versus urban areas. Okay. And the suburban rent growth has been much stronger. It didn't dip as much, although it did dip a lot, but it recovered quickest, or I should say it came back to 0% growth quickest. Mm-hmm. And it continues to lead the pack. So the suburbs have definitely outperformed a little bit in terms of rent growth over the last 3 or 4 months. Now, the caveat that I'll mention there is that in terms of supply, there was an awful lot of supply going into downtowns. So I mentioned that those buildings in lease up are struggling more. So those downtown rents were affected by that much higher share of lease up.
Right.
So I'll use that to then pivot into what does that look like for the future. We anticipate, more of a focus on the suburbs. So this isn't to call the demise of downtown or urban areas, but for instance, as a share of the existing inventory, about 3.5% of inventory was underway in the suburbs versus over 8% in downtowns. We would expect that focus to shift a little bit, maybe come back to closer to even. And the reason is what you cited. You're going to have a little bit more fear around downtowns. And moreover, I think that the work from home aspect is going to play a big role. So we're not calling for basically total remote working. We're not saying that this will happen, of course, but we're not saying that a large share of workers who previously worked in New York will now move to Pittsburgh and work from there. But we do anticipate that more time or a higher share of your days of the week will be spent at home. So someone who had previously gone into the office every day might spend 2 or 3 days at home, or you would go in every other week, something to that effect. We don't call for the utter demise of the office, but we do think that that work from home aspect is not really going away, in no small part because I think it's now viewed as a pretty key amenity for a lot of workers.
Yeah. I think in San Francisco in particular, that's pronounced, where you have a lot of tech companies that are very interested in catering to a employee base that, does get treated very well. And so those amenities are very important.
Yeah, so that amenity, I think, gives people the ability to commute longer. Basically, if you're only going into the office 3 days a week or every other week, I think that drives workers out to the suburbs a little bit more if they are willing to give up those amenities. That's not going to appeal to everyone, but it's a marginal shift. But marginal shifts matter in this business.
Right, that's all economics is.
Yeah. So if you have someone who's willing to commute 50% longer, on top of the fact that they'll get a cheaper rent and possibly more space, which could be important if you're working from home, I think that you get a push out.
Yeah, that's actually something that I hadn't really contemplated. I mean, just to make the math as simple as possible, if you have to come in half as much, you could commute twice as long and be net even.
Yeah,
so,
and I wouldn't think that workers would want to give all of that back.
Right.
When I run these analyses, I usually give them a 50% boost to their average commute time, but it does push what we refer to as the catchment area out a good amount.
Makes sense. There's obviously been slowdowns in terms of the ways that governments have been able to get things done because of the fact that there has been shelter-in-place orders. I'm trying to get a sense of whether developments are acting in their own cycle, and to a large degree, the COVID thing hadn't really slowed down developments to a large degree because the development cycles seem to have come and peaked out, and now the square footage is actually coming online, as opposed to developments which are just now receiving their permits and zoning being stalled. What are your thoughts on that? Do you see current developments being stalled because of COVID to a large degree, or have we kind of passed that given the natural cycle of developments?
Well, I think you're right that we were already kind of in a natural cycle of decline. So the number of units underway peaked in 2019 Q1, and it had been declining for 4 quarters, but there was still a lot underway. And we have seen starts decline. Again, they've been declining for a while, but it does look like there was a more meaningful decline in starts in the first quarter and the second quarter of this year, more so the second quarter. Now, that said, the units coming online has not really been pushed down because of the pandemic. What I've been told is that inspectors have been doing tours virtually. Mm-hmm. You alluded to the fact that a lot of these communities and municipalities have shut down a lot of their functions or made them work from home, which is obviously very difficult for a building inspector. But I think we have 89,000 units as having delivered in 20Q2 compared to 111,000 in 20Q1. And truth be told, I expect that number to grow. We don't capture everything immediately. So for the next month or so, that number is we're going to continue to add units to that. So 20Q2 does not look like it got hit particularly hard by those issues in terms of what was delivering. Now, the starts aspect, I think, is more an economic question. as to what does the world look like in 1.5 or 2 years when I deliver this building if I start it now.
Makes sense. What would you say would be the markets that have been most hit by this? And then also, are there any markets that you're particularly bullish on, given the way it's overcome this particular risk and your outlook over the next, let's say, 2 to 5 years?
Yeah. So this data has been floating around from other sources, but we do agree with San Francisco having taken the biggest rent hit. A good number of core markets have been hurt, and obviously tourism and energy, and some growth markets. So I'll address the core markets. The core markets are very dense. In many cases, they were some of the worst hits by COVID. So consider New York, the California markets now, and Boston. Tourism, again, that's kind of a gimme. That Las Vegas and Orlando were largely shut down. I will say that Orlando's come back a little bit better than I expected, but it did still get hit by rent losses. And the travel industry and hotels are both still showing very poor occupancy and usage. So those tourism markets are still hurt. And that includes some other places in Florida too. And then energy, the oil markets made headlines for weeks and weeks there as oil briefly went negative. So Houston has suffered as well. On the flip side of that, the markets that have done well, or I should say relatively well, are markets that did not have a lot of supply. So this has led to some pretty surprising rent growth numbers. For instance, Norfolk and Detroit have had two of the highest rent growth figures through the first part of the year. But again, that's a function of supply. They just didn't have a lot underway. So the supply aspect is one that drives a lot of our forecasts in terms of individual markets and base in general, not across the board, but in general, the markets with more underway are the ones that we expect to perform poorly in the short term.
That's interesting. Yeah, go ahead.
I was just going to move on to the markets that I'm a little more bullish on.
Yep.
At the risk of sounding like a broken record, because I've been saying this for a year and a half, I'm still on board with Austin. I think that it's a growth metro with a strong knowledge base. It has those low regulations and low taxes that Texas is known for, and it's at this point, it's attracting tech companies to a greater degree than most other metros. And this is where I also want to transition to what we're seeing in our search data. So, of course, CoStar owns apartments.com and a host of other apartment searching websites. And using that search data, I've looked at where are the markets where people are looking more from outside the metro, and where are the markets where people within the metro are looking outside the metro less. And Austin's is a big winner on both of those, as are Columbus, Raleigh, and San Diego. So two of those four, Austin and Raleigh, are those growth metros with high educational attainment. That I've been talking about those for some time, but Columbus, of course, also has a pretty good educational quotient because of the Ohio State University there. And then San Diego, I think, is really standing out because of the biotech sector there.
Yeah, very interesting. All right, well, it's going to be great to kind of continue to track that, especially given your focus on multifamily. But I do want to talk about two other asset classes. You mentioned office. We'll save that for last. I know you have an interesting thoughts on that, given what's going on in that sector. But self-storage is something that our investor base is very interested in. I've been investing in personally for almost 8 years now. Give us a big picture, high-level overview of how that asset class has kind of responded and where you see things going in terms of as the government money starts to run out a little bit.
Yeah. So self-storage, of course, does tend to do pretty well in downturns. At least that's what we saw in the last go through, as people had to downsize and move stuff into self-storage. It's kind of a negative story, but it does positively affect the asset class. Now, that said, self-storage has had a pretty strong supply run up in the last few years. And although deliveries peaked in 2018, CoStar measures about 32 million square feet. Still had a pretty big year in 2019 at 25 million square feet. And we've got about 12 million square feet having delivered in 2020 so far. So supply is still an issue there. And we've seen that reflected in the figures that have come out of REITs. So Public Storage, for instance, did not have a very good quarter in the first quarter for rent growth, although their vacancy also increased. In fact, most of the major REITs reported increases in vacancy. And again, that's a function of supply. But on the other hand, you do have CubeSmart, which also reports their same-store rents reported a pretty good quarter in 20Q1, over 2%, which is more in line with what you saw in 2018 versus what you saw in 2019. So I do think that this pandemic will probably give a little bit of juice to the self-storage industry, in that in downturns we tend to see consolidation of households, which is more people cramming into less space. And that means that alternative spaces for stuff that doesn't need to be in a home will have a more positive driver.
Yeah, and the development of self-storage has been a really significant story from a historic standpoint. I mean, if you look at the self-storage construction spending graph, you see the number of monthly construction spend go from a few hundred million to like billions. I mean, we have billions of dollars being spent every single month now, and that's kind of been the norm. Now, it has peaked out and seems to be trending downwards, but definitely something to keep an eye on. Having said that, the demand for the product is inversely correlated with the economy. And that's a thesis that, yes, we had that thesis. We kind of retroactively created that thesis looking at what happened in 2009 and following that. And it seems to be consistently proven. So when we see vacancies going down, it's not that they're going from 90 to 60. They could be going from 90 to 85. Now, that's significant. And you can feel that not necessarily if you're in stabilized assets, but where you really start to get squeezed is if you've got new developments hitting now and the market is filled with new developments that are hitting now, because you have the combination of the challenges around shelter in place. Self-storage has basically been deemed an essential business. Industrial is an essential business, but people are just not moving as often. So it's interesting. You had a couple different dynamics there where kids may have left college earlier than expected. So you saw a bump that you got in May that you may have thought you would get in June or something like that. But it's a very interesting thing there. Now let's talk similarly. Do you see that the development curve that has kind of peaked and is slowing down, do you see that developments starts are being slowed down by COVID, or that, zoning and permitting is being slowed down by the fact that a lot of these agencies haven't been open and therefore backed up?
It does look like it. So our starts data, again, as with our completions data, lags a little bit, but the starts for 2020 are down significantly compared to 2019, based on the data that I pulled. We're talking about 19 million square feet started in 2019 versus roughly 4 million started in 2020 per this data. Again, as I said, that lags. I would expect that number to go up. And of course, we're only halfway through the year. But at the end of the year, when those numbers get tabulated, I would definitely expect a pretty significant decline in starts for 2020.
Okay. Let me just restate that because I just don't want people to be confused. So it sounds like 2019, about 19 million square feet. And then 2020 so far, it sounds like we've had close to 8. But of course, we're about halfway through the year and the data seems to lag. So would you be shocked if there was a 50% decline in the amount of square footage in 2019 versus 2020?
No, I would not. And sorry, you said 8 million. It's a little less than 4 million.
Excuse me. 4, and I doubled it because it was half the year. Sorry about that. Right. So that makes sense.
So if you doubled it to 8 and maybe toss in another 2 million because of the lag, you might get to 10 million. But that's still close to a 50% decline year over year. So no, I would not be shocked if that were the case. And that's not purely a function of the virus. As I mentioned, these vacancies were ticking up already, and rent growth was, as the REITs were reporting it, the rent growth had really declined. So there becomes less of an incentive to build in that case as well. So overall, I would not be shocked if you saw a pretty sharp decline in starts.
Yeah, thanks for clarifying that. So let's talk about office. I mean, it seems to me to be the case that whenever you have a massive tailwind and a big picture thesis that makes sense, and sometimes the data doesn't really line up yet with the thesis, it can take a little unforeseeable glitch in the matrix to make the thesis instantly come in play. I'll give you an example. So there's been a lot of talk about online grocers taking over grocery stores. And there's, more and more people are buying food online. People are buying food online, but it's a very, very small percentage. Then all of a sudden, COVID happens and we see online grocers just go to the moon, basically. Similarly, in office, there has been for quite some time this talk about work from home, but we saw WeWork and the popularization of that, and we start to think, okay, maybe it's not really going to play out. And then this happens, and then there's this massive push to work from home. And given the amount of tailwinds in the online grocer business and the amount of tailwinds and reasons for people to be able to work from home, sometimes these things establish a new normal, for lack of a better phrase.
Yep.
So what are your thoughts on the state of office, and how do you see this industry correcting and compensating for what we referred to earlier as a potential great amenity to be able to have the flexibility to work from home?
Yeah. So before I get too alarmist, I will say that we don't expect office to go away. We think that there is a lot of value and benefit in being in the same space as your coworkers. As an office worker, I've seen it personally. We also think that there's a company culture that is harder to transmit over, purely over digital mediums, and especially for new workers entering the workforce, I think that it's much more difficult for them to learn and carve out times for learning without that face-to-face interaction. Now, all that said, we definitely are calling for an increase in work from home. And I referred to it as an amenity earlier, as did you. And I think that is part of the driver. Workers, I think, will view it as an amenity. And though granted, we are in a pretty weak employment situation right now, many workers, especially knowledge workers, are not in as weak of an employment situation as the numbers would allow. So I think that a lot of them are going to push for work from home, if they switch jobs, or in the current environment, basically a continuation of what we've been seeing. Now, what that means for office space, in theory, that would mean less office space. Why would you have the same amount of office space if the utilization of it is 50% of what it had been? That's a fair argument. We've definitely heard some stories about tenants cutting space, and office leasing is certainly down. Although how much of that is work from home versus how much of that is poor economic conditions is a little up in the air right now.
Sure.
But the counter argument right now, and I'll admit it's somewhat COVID based, is how do you social distance in an office when we've been cramming more people into less space for decades now? So we have a little analysis that one of my colleagues drew up that looks at, all right, how would office space be affected if you increased your space per worker by 50% versus, cutting the number of people in office by 50%. And, the numbers come out to close to even. It's not exactly the same, but under many of those scenarios, you don't get huge decreases in the amount of office space. I think that the bigger threat right now is really more about a recession. In a recession, you tend to see vacancy rates go up, and that's we're in a recession. So that's actually, I think, the bigger concern for office right now. But going forward, yes, the work from home is probably going to impact long-term demand. One of the buffers for office is, of course, the fact that it has much longer lease terms. So you won't get an overcorrection immediately. Mm-hmm. But assuming that work from home becomes a more in demand and more used amenity, we anticipate that office space will get hit by that.
Yeah, it's interesting. So, going back to 2019, there was already some concerns about vacancy in office, with, vacancy being in the 12% range or something like that nationally, which was a 18-year high. What does the vacancy rate look like now, given the slower leasing activity?
Well, it hasn't really moved that much. Again, a lot of, so this is kind of similar to apartment in that there was a higher rate of renewals rather than new leases. But again, this is a function of how slow moving that market is.
Right.
Office leases are, well, let's say on average, over 3 years, less than 5 years. I'm afraid I don't know the number off the top of my head.
That's totally within reason. 3 to 5 is perfectly reasonable.
Yeah, but it's been a quarter. But looking at the actual numbers, we did see tick-ups in vacancy in both the first quarter and the second quarter. And although they're not finalized, the office market, it looks like, did suffer negative demand in the second quarter. So you do have that supply that's underway, and you already had some negative demand. And we think that, again, most of this is recession related, but we do anticipate further negative demand going forward. So our forecast does call for a pretty significant rise in vacancy.
So I think this particular recession is kind of highlighted what people that have only been in the industry for the last 10 years or 15 years kind of feel intuitively, which is yes, 2008 was an aberration. That's an ahistoric example of what happens when you have a drastic reduction in real estate prices, which is not normal. But just because that was the aberration does not mean that real estate is not a really important factor of the overall economy. And I don't say this because it's a real estate show. I just show that this COVID and the things around COVID and the economic lockdowns, et cetera, you can see that this all works its way into real estate and lenders of real estate being a final determining factor into how bad this can be. An example is if you have a retail store and that retail store starts to struggle, you may talk to your property manager. The property manager may talk to the owner. The owner would like to give you flexibility if they can, and they usually will. But at the end of the day, they aren't even the deciding factor. It's the lender. So the lender gets to decide if you have flexibility. The owner gets to decide if they can grant that tenant additional forbearance or something like that, or a payment plan. How do you see this playing out in office, given that, yes, we haven't seen the drastic reduction in vacancy? You don't typically see that quickly because, to your point about the longer renewal periods, but what you do see is businesses going out of business. Now, to a large degree, the CARES Act may have all but prohibited businesses from going out of business in Q1. How do you see this playing out, working from the government standpoint as well as from the lending standpoint?
Yeah. So, you alluded to that very convoluted chain that stops, or I should say constrains
the death spiral.
Yeah. But it constrains the leniency that you have, right? Because there's instances, certainly if you're working with a local bank, you can probably work something out, but that's not the case in many of these instances. So we do anticipate that being an issue, but it takes a while for that stuff to work itself out. So one question that we've been continually getting asked is like, what's going on with pricing? What is the effect of this on pricing? And the response has been, so far at least, not much.
Yep.
So we use a repeat sales index to identify when pricing is going up and down. And our repeat sales index does not show a lot of movement yet. But the transaction volume has absolutely plummeted. We're talking about over 50 and 60% decreases year over year on monthly transaction data. So my anticipation is that pricing starts to get affected when distressed deals come to market. So that goes back to how does that chain play out and when do those buildings start to come to market? And it does take some time.
What is the repeat sales index? What data goes into that index?
Yeah, so this is similar to what Robert Schiller and Mr. Case identified all those years ago in housing. It's very tough to create a standard pricing number for real estate because you have a tremendous amount of differentiation between products and markets. So if you have to get a quarter where New York makes up 10% of the transaction volume versus another quarter where New York makes up 2% of the transaction volume, the pricing could be very, very different. And it's not really because pricing declined or increased. It's just a matter of what the makeup was. So in order to get a more accurate pricing, we use a repeat sales index, which looks at if a building sells, when did it last sell? What did it sell for? And what's the pricing return in between those two time periods? And then you create an index off of that. So it's purely this repeat sales index, which is considered a better way of pricing or of identifying price movement in real estate. And like I said, it did have a minor downtick in May, but if we look historically, like even over the past couple of years, it's not unusual to get a small downtick like that. That's not to say it's not a harbinger of things to come, but so far we have not seen anything unusual in the repeat sales.
Interesting. Yeah, I think the transaction volume does paint a clear picture as to why we haven't seen some of the things that maybe the economy would imply, in the sense that when this started and when it became clear that this was going to have a huge impact on the overall economy and would almost certainly create a significant recession, though it may be brief in terms of how quickly the economic growth will be negative, I think that a lot of us, and myself included, said, okay, brace yourself emotionally because the deals are coming and they're coming quickly. And now is an opportunity, the likes of which we've been talking about for the last 10 years. Now, to some extent, I want my investors and myself to be prepared emotionally to act rationally when those situations do arise, because I was certainly transacting when every single bit of data said there's no bottom for real estate. And I had to kind of come to terms with that. A lot of listeners to this program, if you've been doing real estate deals for less than 10 years, you haven't had to go to a networking event where everyone's crying, basically. But I have, and a lot of people that I've worked with have done that as well. However, it's interesting because for the last 8 years or so, we've been focused almost exclusively on workforce housing, mobile home parks, self-storage facilities. Why? Because they're recession resistant, meaning that yes, you're going to give up a little bit of the upside that you may get in something like hotels, for example. But the truth is the downside protection is extremely mitigated. So when we do have a correction, even if it's an ahistoric, who could have possibly known that this virus would spread from China and that we'd have these completely ahistoric government lockdowns, et cetera, the thesis continues to play out. So if you saw massive distress, it would mean that I was wrong and that the thesis about these asset classes being recession resistant were not correct. So it's interesting. Now, having said that, I do think that some multifamily buyers that purchased with 80% plus loan to values are going to be squeezed, especially if they just entered the market recently. And I do think there will be some discounts available. But I guess what I was originally prepared for, was those 60% collections data and going, it's going to be a fire sale. Get ready. So just trying to wrap up that, but any thoughts on that kind of monologue I just went on?
Yeah, actually, because when I said distress and talking about, pricing correction, I was really speaking at a very general level. I tend to agree with you, especially on working class multifamily. I spoke at the top of this program about those tenants are going to come under, or seem to have come under increased pressure post CARES Act. You would anticipate some pain there. But we believe that there's pretty consistent downward pressure for workforce housing. So Class B renters that may have, let's say, if you're a salesman whose commission is now some percentage of what it was, we think that there's going to be decreased income in that Class B that leads them into Class C as well. And truth be told, even when times are good, people are still looking for deals in terms of their rent. So, that's why Class C, we've seen their rent growth outperform throughout this entire cycle. I think it's because there's consistent downward pressure. And even in a case where your tenants, your current tenants feel pain, we expect occupancies to hold up pretty well there.
Yeah, great to hear. All right. Well, listen, we have covered a ton of ground like always. I really appreciate you coming on, Andrew. Added a ton of value. Before we jump off, though, let the listeners know how people can learn more about some of the things you put out and CoStar in general.
Yeah. So CoStar is a subscription service, but behind that paywall, we do have a tremendous amount of analysis and news that we put together. Not only myself, but the market analytics team. We do distribute a good amount of that to news media as well. So places like NREI and some media outlets like the New York Times and Wall Street Journal do tend to publish our data as well.
Great to see. And we'll also link to that episode 131 in there. Andrew, thanks so much for coming on.
Yeah, thanks for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.